Hi, everyone. Today, I want to talk to you about something very important, and that is what is happening in the financial markets, COVID-19, and also what's going on in the economy and the financial repercussions, particularly the monetary war that is going on. And for this, I want to share you some information. So first of all, I want to share with you the fact that we are doing a global monetary war game focusing on CBDCs and crypto, CBDC standing for central bank digital currency and crypto. We're doing a capital war simulation. So in September of this year in Geneva, and at the end of the video, I want to extend an invitation to join you. But first, I want to start with the context of a parallel to the 1930s and why this is relevant today. Why? Because in the 1930s, you saw unsustainable debt levels. Back then, there was a deflation risk that actually materializes into the Great Depression. So the Depression is basically a recession coupled with a deflation. So that was a rather big historic depression, the Great Depression in the 1930s. Back then, America was a rising power, both economically and in politics. But at the same time, you also saw rising political and trade tensions in the 1930s, leading to 1939 and essentially the Second World War. Back then, you also had high economic disparities. And this is in parallel to what we're seeing today, even before the COVID-19 crisis in 2020, we saw unsustainable debt levels, by and large, pretty much across the Western world, and also a deflation risk that we could speculate would turn into a great deleveraging, basically a Great Depression 2.0, but with the difference that you would probably see central bank intervention in order to massage that. Then in 2020, you do see China this time being a rising power, now the second biggest economy in the world, and also increasingly having a voice internationally through international organizations and the Belt and Road Initiative. You also see rising political and trade tensions, particularly since the election of Donald Trump in the USA. And of course, the high economic disparities with the Occupy Wall Street movement and the 1%. So here I want to show you the context also of what happened to the US dollar since the 1913, where the Federal Reserve was created. So by and large, you see the US dollar dropping in value 100 years after the creation of the Federal Reserve in 2013. You essentially see that the dollar has lost 95% of its value, and now it's even more. So this is relevant because since we are comparing to the 1930s, in 1929, when you saw the beginning of the Great Depression, you actually saw the dollar go up, even though by and large the dollar was going down in value. But this is because we were still on the gold standard. In 1933, and then since then, we see the dollar drop. In 1933, FDR basically issued an executive order making it illegal to hold gold coins or bullion. And so this is where we actually unpeg from the gold standard with some sort of a mixed standard leading up to 1944 with the Bretton Woods system, establishing the dollar as the world reserve currency, the creation of the IMF and the World Bank, essentially determining a dual or a hybrid system, fiat and gold, with a convertibility of $35 an ounce. And this actually leads up to 1971, where we go into 100% fiat system with the Nixon shock, the abolition of the Bretton Woods system, where Nixon actually suspends temporarily the convertibility of the US dollar into gold. And we have been in a 100% fiat system ever since. So this is the context of what we're seeing, because it is relevant. Also, I want to point out a sovereign debt relief article that was published on the Journal of European Economic Association, called Sovereign Debt Relief and its Aftermath. We actually see basically default, something that will leave essentially its default. So you see throughout history, actually defaults are not that rare, be it flat out default because they do not pay, or technical default because they pay with worthless money, or because there is so much inflation that and debt monetization that is paid with money that is worth nothing. But back to today, what we see today, and that's very important, is that we see government and central banks having a dilemma. Essentially, governments and central banks are stuck between a rock and a hard place. They basically have two choices: either do something or not do anything. Both have a tail risk that can be associated to it because of the large leverage in the financial markets and in the entire system. So the first thing, the first tail risk is if they do nothing, right? So if there is no fiscal and no monetary stimulus, we basically ensure an economic crash. We already know that a recession is very, very likely at this point, but we don't know if we're also going to see an out-of-control deflation because of this financial deleveraging. So essentially, this would create a Great Depression 2.0, but we're starting from a much bigger leverage. And so the flip side of that coin, even though we could see as a reset of financial deleveraging a good thing, on the other side, I mean, this comes with a lot of defaults from pretty much across the spectrum, from corporate debt to personal debt to sovereign debt, and also a huge recession. So this is nothing that we actually want, but eventually we do know that there is a need for a financial deleveraging. Now, the other thing is to do something. And we've seen monetary stimulus already since 2009 with unorthodox policies and basically central banks reducing to zero their monetary policy at the zero bound. And now with the coronavirus, we even see asset purchases into equity markets that was already before, and debt market, but now they even include junk bonds. So you now see a lot of pressure on fiscal stimulus, both by central bank and actually people demanding fiscal stimulus. The problem with that is that you can have, you're already depart from an unsustainable debt burden, and if you do more fiscal stimulus, then the burden becomes even bigger. Also, if the fiscal stimulus and the monetary stimulus become successful, this is in the best case, you have a risk of runaway inflation, right? So this, in effect, the bottom line would be debt monetization on the one side, but the flip side of the coin would be a loss of confidence in money, in the fiat system. So, there's a great book out there by Ray Dalio called Navigating Big Debt Crisis, where he basically calls for a beautiful deleveraging, if there is such a thing, because a beautiful deleveraging would be basically a financial deleveraging that would be compensated by fiscal and monetary stimulus. But the problem with that is, it's very hard to manage, and at some point you can either overshoot or undershoot, and that's the question essentially, is what's going to happen. I mean, since the coronavirus, we clearly see that actually people demand governments to step in. And the problem with this is that you do see basically a takeover of the entire economy by the public sector, and you see a takeover of the financial markets by central banks. So you can also question if there is now a free market, or if there isn't a moral hazard in terms of pricing. The price discovery is now basically controlled by central banks, who decide which assets to prop up and which assets not to prop up. But that's another question. I mean, if you want to try to forecast what's going to happen, most likely, if you have a choice between runaway inflation and out of control deflation at this stage, it's more likely that they would rather have runaway inflation, for which they have the tools because they could raise interest rates, rather than have an out-of-control deflation for which they have no tools except from printing like crazy, because you're already at the zero bound. And if you go negative rate, essentially you would see a long-term deflation happening as well, because if you have negative interest rates, the long term is also removing money from the monetary system. So most likely what's going to happen is first tail risk number one, and then at some point we will need to have financial deleveraging. Hopefully, if Ray Dalio is right, and if it's very well managed, then we could see a beautiful deleveraging, but I personally doubt it. So why am I telling you this? Is because you need to assess that situation and also try to figure out what to do. That is why we also doing this monetary war game simulation. And we're basically establishing different players, right? So you have the private sector initiatives, the semi-private initiatives, and the international organizations or public initiatives, where we are actually placing Bitcoin as a private initiative. Even though we don't know who Satoshi Nakamoto is, we can assume that they are rather on the libertarian side of things because of the clues that were included in the Genesis block talking about bank bailouts by central banks. So we assume that they are a private sector initiative, even though we don't know. Then there's AGAU. So we are clearly a private sector initiative. AGAU, AGAU, one token backed by silver, one token backed by gold, essentially doing a real gold standard 2.0, where you have allocated gold and you have the possession of the precious metal directly owned by the user instead of having a central bank holding it. And then you have Facebook Libra, which is basically so far a private initiative as well, but it's backed by Fiat, which is in opposition of the idea of Bitcoin, which is an alternative to Fiat. So in this way, we kind of join the idea of having honest money, private money, and also non-inflationary money. So you have on the other side the semi-private initiative. Now, I call them semi-private because we know that the Federal Reserve and the European Central Bank are private institutions, but we also know that they're heavily influenced by the governments. So this is the model of most of the central banks around the world. And that's why we call them semi-private. But then you have the fully public initiatives, such as the PBOC, the People's Bank of China, centralized planning by the Chinese government. And then you have the international organizations who have a special status. So as we saw, the IMF and the World Bank were created for the Bretton Woods. But then you also have the BIS, the Bank for International Settlements, which is basically the nickname, the central bank of central banks. And then you have all of these players having their initiatives, or the speculation of an initiative, such as the speculation of a digital euro, or the speculation of the SDR and SDR special drawing rights, basket of currencies run by the IMF, which would be one way to essentially align the Western world by including them in the basket and have this world globalist money. So that's why we start this monetary war game with assumptions where you have the USA on the one side and Chinese on the other side, be it a declared or undeclared war, a global economic situation similar to the 1930s with high debt levels, a potential great deleveraging in the play, and then also, of course, this would include, technologies such as 5G, blockchain, AI, IoT, and chemical. But we will focus on the capital war side of things. With historically, you see that there is a currency war, then a trade war, and then eventually it expands into a full blown out military and technological war. So we will start this simulation in September in Geneva. We will be arranging as an initiation of different blocks, assuming that Europe will initially be on the side of the USA because of, since the Marshall Plan, you see tight links between the two, Europe and the USA. But then you also see links with the international organizations such as the IMF and the World Bank, which were created at the initiative of the USA. And then on the flip side of that, you have China, who will be trying to gain influence through the proposed Belt and Road Initiative, and then a big role of the Belt and Road Initiative and the rest of the world to be played, because a lot of these countries, even though they have a high dependency with China because of trade deficits and trade links, a lot of these countries also have a lot of debt with the IMF. And then on the other side, you have the free market or capitalist bloc, which are basically fighting for free competition of monies and eventually and essentially know if there is in fact a free market or not. So I invite you with this. I hope this information is useful. I invite you to this world event that is coming on September 18, 2020. It will be in Geneva, Switzerland. So this event is powered by stakes.io. And if it's only a webinar, we will give 100% of the donations to the Red Cross. If it's a physical event, we will give 10% of the profits to the Red Cross. The webinar will be free, but you will be able to also support us with the sponsor package. More importantly, I hope you can share and like this information. Just give us a like and share for other people to grasp this information. Follow us on social media, Facebook, Twitter, YouTube, and also LinkedIn. You can visit agao.io, contact us, info@agao.io, or my Twitter handle is @ThierryHarris. The Twitter handle of Agao is @AGAU Crypto. And then also, please don't forget to schedule this. Go to stakes.io. We're going to share the links below. Please give us a thumbs up and tell us, what do you think about this takeover of the economy by the public sector? What do you think about the takeover of the financial markets by central banks? And what do you think is the most likely scenario that will happen? Save the date, September 18 in Geneva, Switzerland. We will be joined by very high-level experts who will be representing the different players. And then we hope to see you very soon and join us. Take care.